Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Alright, we have these new factories online making cells, batteries and vehicles. It looks like 4680s will work, but possibly taking a little longer to ramp up than initially thought, likely due to not enough automation yet. Either way, it looks like Tesla are going to get there, be it potentially somewhat delayed. The point is that one day in the near future, we'll have 4 vehicle factories at close to full capacity. It may be next year, or it may not be for a couple more years. But these factories are now officially open and making cars, and Austin is also making cells. Within time, there'll also be more cells available from CATL for Tesla too, so they can keep ramping up in China. Eventually even, it's hopeful that the 4680 line ramps up fast enough to have enough gigawatt hours for Cybertruck. So let's see if we can try and work out a valuation for Tesla's car business, and I mean just the car business, from these 4 factories when they are at full capacity. We're going to take the capacities of each factory as we've been told, and we'll remove the potential for sandbagging. Perhaps this can be viewed as a conservative estimate. There is just the reality factor of how much larger Texas is than Shanghai, and how many more vehicles Tesla could potentially manufacture there. Either way, I think it would be good to have some indication of how much these vehicle factories are actually worth. So let's get started. I'm going to calculate the run rate that these factories would be at for a quarter that is at full capacity. We will then try and calculate how much profit we expect and assign a valuation from there. Starting with Fremont and the 2 oldest models, S and X. I feel fairly confident that Tesla can reach 30,000 units a quarter for these 2 models. Elon has said that they plan to double the output of those lines, but no reference as to what number Tesla were doubling from. The run rates were around 30,000 before the inception of the Model 3, so seems definitely possible. The Model 3 should have ample battery supply now the standard range is using LFP, which means there are more 2170 cells available for the Model Y. I believe Tesla will keep making the long range and performance Model Y at Fremont. I can't see this changing for some time. We were told that Fremont should ramp up about 50% more though. I'm going to take the Model 3 to 70,000 units and the Model Y to 90,000. I think the Model Y will still be that much more popular and carry that much more profit than the Model 3 that Tesla will simply make it a priority, despite the extra supply from Austin. That's a total of 200,000 vehicles from Fremont, which is probably in line with Elon saying what they expect 50% more capacity over the next couple of years there. Alright, so what capacity might Shanghai have hit by perhaps around late next year? Well, in January we saw Shanghai produce over 68,000 vehicles. Remember, Tesla were chip constrained and battery constrained at that stage. Next year, CATL would have ramped up their LFP production even further, and the chip shortage should be a thing of the past. We often hear about China hitting a potential run rate of 1 million a year. Well, I think that's probably accurate. So let's lock in 250,000 from China for the quarter. I'm going to split this number into 85,000 Model 3s and 165,000 Model Ys. China will have a new fab though, which would likely be up and running by this stage. I think it would be accompanied by CATL's new fab next door too, but I'm going to leave this out in this model. There is a good chance there is an additional 100 to 150,000 units a quarter coming out of there. We've actually just heard that Berlin is meant to be changing over to 4680 cells in fall this year. I wasn't expecting this to occur until the start of next year. Therefore, we should expect Berlin to be at full capacity soon enough sometime next year. Now, for full capacity for Germany, we've been told is a new model every 45 seconds. With 100% uptime, that is 700,000 vehicles a year. With 80% uptime, then we're at 560,000. However, I feel like we can round this up to 600,000 and it still feels overly bearish. And I'm sure you would agree. Although I think Tesla only have a permit for 500,000 vehicles in Berlin, but I would expect that something can be done about that. So this would come in at 150,000 units a quarter for Berlin. Also, in order for Berlin to match production capacity with 4680 capacity, I would expect a new fab next year, possibly for the Model 3, but we'll not include that here either. Well, we also heard the same rate of a model off the line every 45 seconds in Austin, so we can add 600,000 vehicles a year in there too. I mean, I'm pretty sure that Shanghai is already at that pace, or has even been higher at times, so part of me thinks this is a ridiculous number. However, I still think it'd be good to know the profit potential from these numbers anyway. Now, we did say ramped up, so that would also imply the Cybertruck. Now, Elon is saying end of next year, and ramping will take some time, but we need to add it in really. Elon says Giga Texas can do over 1 million a year, so perhaps Cybertruck will also be about the same as Model Y. Remember, it doesn't need a paint shop, which is quite a big deal. So I'm going to place 600,000 Cybertrucks a year. Now, we could also add in the Roadster and semi-truck, but that might add to unnecessary complexity. This gives us a total of 890,000 vehicles for the quarter, which would be at a 3.5 million annual run rate. Perhaps you might consider that around the start of 2024. This should be the run rate Tesla have achieved, or close to it. Perhaps a bit more Cybertruck ramping still to come. I think that number coincides reasonably well with Tesla at 70% growth, basing 1.6 million from 2022, and we're talking about reaching a run rate of 3.5 million at the start of 2024. So I'm happy with these figures. Well, we would have probably seen more price rises by this stage and possibly more inflation too, but it's profits that we're most concerned with, and if there is inflation, it will likely be rectified with more price rises, resulting in about the same profit. Therefore, I'm just going to calculate this all based on today's prices. Feel free to discount it back to whatever makes sense to you. It might be possible that Berlin makes a long-range 4680, but I'm not entirely sure. It might mess with the product mix too much. On the other hand, they are having to send the long range and performance all the way from Shanghai and pay tariffs, but at the same time, they will have these 2170 cells that need to be put in some vehicle, so I'm going to go with the same all-wheel drive Model Y from Austin being manufactured in Berlin, with an average selling price of around $61,000. I've also estimated the average selling price of the Cybertruck, at least for its initial ramp, at $65,000. I'm only going to include FSD at the take rate we have today and the revenue we're able to collect today. We're going to exclude future FSD potential from this model. Alright, with that we can calculate the total revenue for this quarter, which comes to $53 billion, or over $200 billion annualized. This is about 3 times the revenue Tesla are at today, or at least compared to Q4 2021. This is a big jump, and will carry more economies of scale and higher margin vehicles. So let's get to the profits. Now we probably still have some credits floating around, so we'll just add 250 million in there for good measure, taking us to a nice round $54 billion. But now it comes down to profit margin. Due to these factories being at higher capacities, then margins should also be higher in general, ignoring commodity prices somewhat, as it's very likely Tesla had long-term contracts anyway. On top of that, we're now dealing with increased prices. Remember, if costs increase 20% and prices increase 20%, then profits also increase 20%. At the end of the day, it's the actual amount of earnings that is the determining factor for the stock price. Now, with this level of growth, the new facilities are responsible for 50% of the production, and I think they would have easily hit over 40% margins, especially with the structural 4680 packs and front and rear castings. But let's lock them in at just 40% and add to the others at a base of 32% margin, resulting in an average of 36% margin overall. So I'm locking in 36% margin here. I mean, we are assuming a somewhat perfect quarter here, where there haven't been any supply chain issues, wars, lockdowns, or any other catastrophic events that resulted in any issues. This gives us a gross profit of close to $20 billion. Pretty good. This auto profit is going to be the total gross profit we use, as we're not interested in other sides of the business, as this was a valuation based on just the auto business. Now, like I said, just the auto business, so this also needs to be reflected in costs. The majority of R&D is in FSD, and we're only taking today's version of FSD and selling it at today's prices. We'll not be factoring in FSD or robotaxi breakthroughs with the PE ratio. Therefore, we should not be including future FSD advances in the R&D. I'm cutting the R&D down to $150 million a quarter. It's usually around $500 million. SG&A, I'm going to place a bit higher than it usually is due to the expansion, but not relatively. This is economies of scale. You see, if Tesla double their auto production, SG&A may only increase 20%. In other words, the SG&A per vehicle diminishes with scale. And remember, this is just for the auto side of the business too. We're not including the OPEX for the rest of the business. This gives nearly $18 billion in operating income. Incidentally, a 33% operating margin, which is over twice what Tesla achieved in Q4. Again, more of the economies of scale kicking in, and Tesla's vertical integration for their own in-house cell and battery production. I think tax is going to start getting a bit higher, as revenue is growing too much relative to the capex to depreciate. Tax doesn't work so well with economies of scale, it kind of does the opposite. Leaving a net income of $15 billion, which is pretty good in my opinion. Annualized, that would be $60 billion, which at today's stock price would mean a PE ratio of just 16. But what PE ratio should we place on this company? Remember, this is just a car company in this valuation. Tesla likely still have plenty of demand and could expand these factories and new locations, along with adding more models. Of course, the future models will all be more vertically integrated with in-house cells and thus also having the higher margins. There won't be any competition that should be forcing Tesla's prices or margins down. In other words, the future expansion will still be profitable. I mean, even from a bearish view, we might expect production to just double over the next 3 years, which would likely further triple actual profits, which is probably how I would base the PE ratio. I also think the EV industry naturally gets a much higher PE ratio than ICE, and I've explained why in previous videos, and that I think Tesla should also have a higher PE ratio on top of that again due to their margins, vertical integration and technology. Therefore, I feel like a PE ratio of 50 is justifiable here, just for autos. Remember, this doesn't factor in any FSD, bots or even energy. If you think that is high, well, Tesla have demonstrated success with their own in-house battery production and should simply be able to repeat it again and again. Well, this comes to a market cap of $3 trillion, or approximately a $3,000 stock price. Now, on top of that, I do expect FSD to have made some more advances by this stage, and once it actually looks like a possibility of coming into fruition, then that will increase the PE ratio further. Of course, if you think I've chosen a PE ratio that is too high, then change it yourself. The math isn't difficult to work out the valuation. And the market may have changed in general by this time. PE ratios could be lower if we see interest rates rise. I think this is a good model that we can build on and play around. I might use it again and experiment with different cases. Notice how although revenue had only increased threefold from Q4 2021, earnings are up over 6 times. This is the economies of scale kicking in more, which I don't think the market is fully valuing in. This spreadsheet is also available in some of my Patreon memberships too. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.